marginal and absorption costing. We are looking at marginal and absorption. Before today, we've actually looked at the cost card, all right, in the previous lectures, and we are going to expand on that. So we are looking at marginal and absorption costing. So you saw the lecture on accounting for overheads, and we are building on that. So we are looking at marginal and absorption costing, and this is under the general topic of the traditional costing method. The traditional costing methods. We will look at the modern one very soon, like the ABC costing, life cycle, and all those things. But for now, we want to take a look at marginal and absorption costing. The whole idea of marginal and absorption costing is to help us to price a unit of a product. So we are trying to cost a product. Place a cost price on the product, and also try to sell it so that we can get a profit. In financial reporting, we learn how to prepare trading profit and loss accounts, and that is the same thing. So here, our focus. So this thing is like a manufacturing account. All right. So it's like a manufacturing account. You see, when you are doing normal P&L for a trading company, what you normally do is that you start with your sales. And when you do sales, you say less cost of sales. Then in the less cost of sales, you will start with opening stock, add purchases. The idea here is that we don't buy. We are not a trading company. We are a manufacturing company. And here we are going to put in the production cost instead of add purchases. So that is how it's going to be. So that is what we are going to actually try to learn under marginal and absorption costing. So in terms of expanding on the marginal and absorption costing, I'm going to break the board into two because in the traditional costing, like I've explained, there is a marginal and there is a absorption costing. We've actually done absorption accounting for overheads, and that is where the whole issue is. As for the direct material and things, there aren't that much issue. All right, so now we are trying to cost a product. We know that every product, the combination, a cost of a product, if you want to cost a product, you will need the basic elements. You need the three basic elements for costing the product. Element one is your direct materials. Direct materials. We know you will need your direct materials. And that one is easy. You just need your quantity of production. Then you get the per unit price. So quantity per unit multiplied by the price. All right. So that will give you your direct material cost. Then you also need direct labor. So you do direct labor. So also there is accounting for labor. So you do direct labor. And the labor, it is based on the time. So we are looking at the time per unit. And you multiply it by the hourly rate. So the rate per hour. Per hour. So this one too is price per unit. So the quantity multiplied by the price per unit. All right. So this side should be quantity multiplied by price per unit. The quantity that you produced multiplied by the price per unit. All right. It looks as if the machine is a little slow. All right. So you will need the quantity you produced. Or in this case, you are talking about 1 1. So the quantity you use to produce 1 unit multiplied by their price, all right? So we can say quantity per unit multiplied by price per unit, because we want the price of 1. So this one to time per unit, then you are going to multiply that 1 to by the rate per hour. All right, so that is that. Now the main problem is the last one. We will need overheads. Of course, you can say you need direct expenses. All right, so if there is direct expenses, so let's say direct expenses like wages standing on its own, or let's say royalty. All right, you need them per unit. Everything is per unit. So you need these 3, and we call these 3 what? Prime costs. I hope you remember that. These 3 are prime costs. So the problem, and all these 3, they vary with the level of production. With the level of production. What we mean is that, you see, if you are producing 10 units, the quantity of material you have to increase the quantity of the material to the number that will be able to produce 10 units. If you are producing 20 units, you have to increase your quantity to the number that will be able to produce 20 units. So it varies. It varies with the level of production. All right. So that one, we put them together, we call the prime cost. But the whole issue of this marginal and absorption costing is coming because of the overheads. The overhead, the indirect, all these things are direct. So the indirects of these, all right, that is where the whole issue is coming from, the production overhead. So in treating the production overhead, that is where the difference of marginal and absorption cost comes in. But whether marginal or absorption costing, these 3 are always the same. They are always the same. So how do we do marginal and absorption costing? How do we do the overhead here? Now, a typical example of overhead, if you remember our accounting for overhead, is, let's say, rent. Rent. Let's say rent. Another example is depreciation. All right. These are overheads. Insurance, these are them. But I'm going to use the rent, for example, to explain the whole concept. All right. So now, we need to understand marginal and absorption costing. And I'm going to start with the absorption costing. I think we've already, because the last lecture before this was about accounting for overhead, I'm going to start with absorption costing. So let me make the board 2 here. So I'll use this side to talk about absorption costing. And I'll use this side to talk about marginal costing. All right. So what is absorption costing? Another name for absorption costing is called full production cost or full cost. All right. Full production cost or full cost. And another name for the marginal costing is variable costing. Variable cost. Like I said, the issue is not about the prime cost. We don't have any issue about the prime cost. The only issue we have is about the overheads. How the 2 systems treat overheads. That is it. We use this one in financial reporting. This is what we use in financial reporting. And I said the last time that even our tax laws in Ghana, Section 41 supports absorption costing. It supports full costing. Now, what is the idea? If you remember anything in FR, it says that the cost of something is the purchase price plus any other cost incurred in bringing the thing into its useful state. So the cost plus any other thing incurred in bringing the asset or whatever it is into its useful state, if it is inventory, to its saleable state. Don't forget, this thing is about us valuing a stock, 1 unit of a stock. So we are doing 1 unit, a unit of a stock. So here, if you look at your absorption costing, it is in line with IAS 2. So IAS 2 says that it is the direct cost, all right, the purchase price plus direct cost incurred in bringing the inventory to its saleable condition. So this thing we are doing when it comes to absorption costing, it has no difference with FR at all. So what does it mean? They are saying that if we want the full cost of something, then it means we are going to absorb the overhead into it. That's why we call it absorption, overhead absorption. All right. But before we go into that, I'm going to give you a template we used to do absorption costing, the format that we used to, and I'll explain it. Then we solve past questions with that. All right. But I want you to understand how reporting is done in both marginal and absorption costing. How do we do reporting? Like a profit statement and income statement. How a profit is reported. All right. How do we report profit? Now, if you know how we've been doing accounting from level 200 accounting, or in some cases level 100, we know that you will need your sales. You know you will need sales or revenue. All right, you will need that. After sales, what do you normally do? What do you normally do? You less cost of sales. All right, but here our cost of sales is going to be how much we produced. Okay, so that is the thing, how much we produce. So you will see that you will be lessing total production cost. So here you will less production cost. And I'm going to expound on this. You less production cost. And once you less production cost, you get your gross profit. So that is that. Production cost, then you get gross profit. So for this one, this is how we get gross profit. And if you want your net profit, then you will less non-production cost. Like the same thing, like the way we do in FR, you will less operating expenses, those things that are not tied to your how you produce the thing. All right, so you less your non-production cost. And when you less your non-production cost, you now get your net profit. That is how marginal absorption costing works. So we are going to open this format up a little very soon. All right, we are going to open it up very soon. The whole issue, and I'll expand it because this one, production cost, as we learn in the cost card, has a lot. There's a whole way you do the production cost template. So that is how that part works. All right. But when it comes to the marginal costing, how is reporting done? For them, what you are going to do is that you are going to do sales. But what you are going to less from your sales is variable cost or marginal cost. So you less variable cost or marginal cost is the same thing. Like I said, it's the same thing. So you less variable cost or marginal cost. And I will open up the format and you will see very soon. Now, once you get this, you get what we call contribution. So we don't use the concept of gross profit. Here we call it contribution. All right. Now, once you get your contribution, then you come and less all your fixed costs. Fixed cost. Now, the thing is that in this production cost, there is fixed production cost and there is variable production cost. Variable production cost. In this one, whether fixed or variable, we combine it and put it here as production cost. But over here, we only use variable cost of production. Then we will come and less the fixed cost of production. So that is what will happen. We will less the fixed cost of production here. then we now get our profit. So that is how this one works. So whilst in, you see, in absorption costing, like I said, it is in line with IAS 2. So it says that all costs incurred in bringing the asset into its useful state, or all costs incurred in bringing the inventory to its saleable condition. So here you will see that when we are talking about the production, the cost incurred, the direct cost incurred in producing the thing, plus any other cost incurred. So any other cost, and please, here we are looking at production, all right? We are not selling yet, we are looking at production. So here you are looking at both the fixed and the variable together in the production, but here you will split. The variable is the one that is deducted first to get your contribution, then you come and less your fixed. That is how reporting is actually done in marginal and absorption costing. But I'm going to give you a full template that we use when you are reporting on marginal and absorption costing. Then we will take some example and we will look at it. All right. How you do overheads absorption, I think we've already done that in the overheads accounting. We said that if you want to know we use the absorption rate, overheads absorption rate. I think you remember that. We have budgeted overheads. The formula is budgeted overheads. That's the total budgeted overhead over budgeted what? Level of activity. And I explained in that video that when we say level of activity, a level of activity can be the production unit. It can also be the labor hours. All right. So you need to take note of that. So it's either the production units or you are looking at the labor hours. All right. So that is that. Okay. In that said, we are going to take a full template of what we used to do reporting, either absorption or marginal. So here I will use here for my absorption again. How do you do? So absorption costing reporting. Absorption costing reporting. And I will use here for marginal costing reporting. I said another name for the marginal costing reporting is what? What is the other name for marginal? I said that one is variable costing. So take note of that. And I said the absorption is what? Full costing method. So you take note of that. All right. So how does the template work? So here you will start by getting your sales. All right. And sales or revenue. And how you get that is to multiply your sales unit by the selling price per unit. And you will get your sales down. Then, like we always do in financial reporting or financial accounting, you will less cost of sales. And we know that as we learned in uni, this side starts with opening stock. Opening stock. So you realize that the marginal and absorption costing is an issue about issues of your closing stock, and we will talk about that. So you need your opening stock, and your opening stock is simple. You need the opening stock units. Opening stock units. Then you multiply it by the cost per unit, the cost price per unit. All right, so you will get that. You have that. Then in reporting, we will say add purchases. But here, we are not buying. We are the ones producing. So you are supposed to add production cost. You add production cost. And the production cost, bear in mind, we said that you will do direct labor, direct materials first, sorry. You will need direct materials, and we know the quantity per unit over price, multiplied by price per unit. You will need direct labor. You need direct labor. All right. If you have direct expenses, you can add direct expenses. You have them. All right. Then these ones gives you your prime cost. These ones, these three is what we call prime cost. When you get your direct ones, then you add production overheads absorbed. So I'm going to put that in red ink. Production overheads absorbed. And take a look at the format very well. Production overheads absorbed. And how do you do the production overhead absorbed? You will use your formula for determination of overhead absorption rate. So the formula that you use to do overhead absorption rate, the OAR, overhead absorption rate, which is given by budgeted overheads, and you will have it in the question, over budgeted level of activity. And the budgeted level of activity can either be in terms of labor hours or production unit. So take a very good care of citing those ones. So the budgeted, it can be about the level of activity, can be about production unit, or it can be about what? The hours, labor hours. So take note of that. It won't be the two. It's supposed to be one of them. So that is that. Budgeted labor hours. All right. So take note of that. So you are going to do that. When you get the answer, it will be per unit. Then you multiply by the level of activity. All right. So basically that is that. So we will come to that. Of course, we will solve some questions on that. So I kept this one in a red ink. So you are going to add them. All right. So that is that. Then when you finish, you will less closing stock. That is how you find cost of sales. So you will less closing stock. You will less your closing stock. You less your closing stock. But the closing stock is the issue, because how do you find closing stock? Normally, closing stock is easy. So let me show you how we find closing stock. So for closing stock, what you will need is that you will need your opening stock. So as you can see, opening stock. All right. You add your production unit, then you less your sales. So you need opening stock, add production units, then less the sales units. That's how you find closing stock, which will be valued. And when you are valuing it, that is where the issue will come from. You are going to value those ones using the absorption. So that is that. So please take note that here we are going to value closing stock using absorption rates. That is it. All right. So take note of that. We are lessing closing stock. And whilst you less your closing stock, you will get your cost of sales. So take note of the template very well. Once you get your cost of sales, you will get gross profit, like we know in reporting. So you get gross profit. Gross profit. And since this one is about absorption, anytime there's absorption, obviously there will be over or under absorption. Under absorption is like a loss, and I'll explain the under absorption and the over absorption. So we have under or over absorption. So the gross profit that you have there, this one we call it unadjusted. Unadjusted. And so you adjust it with your absorption, under or over absorption. Now, what is under or over absorption? Now, the absorption is this. We learned overhead accounting. And over there, we said that absorption is about allocating or sharing the overhead to the unit cost of a product. So you are sharing, let's say you have a building, all right, for which you pay rent. The building is probably for the administrative people or administrative and the factory at the same time. Now you see that they are using the building for manufacturing, and at the same time, some people are using it for administrative purposes. So we want to know the part of the building we should put in our cost so that the customers will pay us for that. That is what we do. So assuming that we had a budget for the rent overhead. So we budgeted for, let's say, 10,000. All right. And at the end of the day, the actual is 12,000. All right. So what has actually been absorbed is what we have. So the budgeted is there. Okay. And you have the actual one that you have cited. So let me say that you have absorbed in 10,000, but in actual sense, you have, let's say, 12,000. That one means that there is an under thing that happened. You underdid it because the actual is higher than the absorption. It is under, which means that who is supposed to pay this? It is the company that is supposed to pay this, which means that it will be like an additional expense to the entity because you underdid it. So somebody should bear the cost of that. That is it. So if you underdo it, then it means that you have suffered a loss. It is a costing thing you've done. And so if you under-absorbed it, then it is a loss to you. And since it is a loss to you, you have to subtract it from your profit. And so when it is an under-absorption, you are going to subtract. That is an under. All right. But when it is an over-absorption, you are going to add back. All right. So that is that. It's an additional. This one is a loss. You underdid it, means it's a loss. But if you overdid it, then it means that it is kind of a profit. You are going to be collecting that one from your customers. So you'll be collecting more from your customers. So that means that the part of the rent that you have put, so this one, the absorbed, let me call it the absorbed. All right. It means you said that in the production that you are doing, you absorbed only 10,000 of your rent into the cost of the product, just one unit of the product. You absorb 10,000. But in actual sense, it is 12,000, which means you underdid it. All right. So basically, that is that. You underdid it. Now, anytime you underabsorb, that means that will be an additional expense. Somebody has to take care of that, and it is a loss to you. If it is a loss, you have to deduct from your profit. But if it is over, then it means that you are going to enjoy taking that money from the customers, and it is a profit to you. So basically, that is how the under and over absorption thing works. That is how it works. And we are going to practice with an example so you understand it more. All right. So basically, that is that. And so when you get this one, you will now get your adjusted gross profit proper. So you have here adjusted gross profit. Gross profit. All right. So that is it. Now, after you have done that, then you are going to less your non-production expenses. All right. So you less non-production expenses. Let me ship these things out. All right. Okay. So we've actually less all our production expenses. Now we are we are going to less our non-production expenses. But the non-production expenses, we have the variable non-production expenses. Variable non-production expenses. We call them non-production overheads. All right. So this one will include something like your variable selling overheads. Or your variable distribution overheads. All right. So these things, you put them together. So you take them out. And also you less your variable. No, this is the variable. You also less fixed non-production overhead. At the end of the day, the main focus will be the fact that they are non-production, fixed non-production overhead. And those ones too can be the same thing. Fixed non-production overhead. It can be fixed selling price, selling overhead, fixed selling overheads, fixed distribution overheads, and fixed administration overhead. So they are all fixed admin overheads. So you put all of them together and you subtract from your adjusted gross profit. Then you have your net profit. So we're going to pick an example to look at it. Net profit, so that you understand. So this is the template for the absorption. The key thing is these things. One is your closing stock, which you have to do it using the absorption. Closing stock, that's the main deal, and the under or over absorption. All right. So basically that is that. Let's pick a question. Let's look at it. All right. But bear in mind, you've seen how we calculate closing stock if it is not given. All right. And the fact that if there is an under absorption, it will be a loss to us. And so we have to subtract, or you can say you add it to the cost. All right. You add it to your cost. If you add it to your cost, you are still subtracting from your sales, or you can say you would subtract it from your gross profit. All right. So either way, that is that. If it is over absorption, then that one, hallelujah. What you are going to do is that you are going to add that one, or you add it to your profit, or you can also say you will decrease your cost. So whichever way you put it, either add it to your profit or decrease to your cost. Because if you decrease your cost, your profit will go up. All right. So you can do it both ways. Either you decrease your cost, or add it to your gross profit. So that is that. So let's take another example with that. And we should be able to deal with all forms of question that is requiring us to report using absorption costing, given this template now. All right. So let's pick a question and let's look at it. All right. So I think we have a question here. A simple illustration here, illustration 8. All right. So let's look at that. And we are going to use this same template. So let me give you some few minutes for you to look at the template very well. Okay. So you start with your sales. you less cost of sales, and the cost of sales, you start with opening stock, you add your direct or your prime cost, you absorb the overheads into it. All right, you absorb the overhead. Now the overhead is production overhead, so it doesn't matter whether fixed or variable. We say production overhead, so it means the two of them, fixed production, variable production. You less your cost of sales that you have done using the absorption system. All right, so take note of that. Okay, then you take away or you adjust it with your over and under absorption. You get your adjusted gross profit. Then you less all your non-production overheads, either fixed or variable. So that is that. So we're going to take this, look at this question. All right, so that is it. It says that why, this is what we have. Why produces, why PLC budgets on working 80,000 hours per month. So the budgeted hours is 80,000. And having fixed overhead of 320,000. During April, actual hours worked was 78,000. And the actual fixed overhead was 350,000. A, calculate the overhead absorption rate. B, the amount of any over and under absorption in the month of April. So that is what we have. So now, A, we should do the overhead absorption rate. And the overhead absorption rate, the formula for overhead absorption rate is what? Budgeted overheads. Do you remember the denominator? Mohammed?
Sir,
Divided by what?
budgeted level of output or level of production.
Or level of activity. It can be production, it can be hours. So you use budgeted level of activity. Now, the level of activity can be production or it can be labor hours. So depending on the question, all right? Depending on the question, but that is the formula. Now, if you look into this one, what is the budgeted overhead? The total budgeted overhead. Total budgeted overhead. Total budgeted overheads. So if you look at it, it tells you that YPLC is working, YPLC budgets on working 80,000 hours. So that is the level of activity they have budgeted for, that they want to work 80,000 hours. That is the budgeted level of activity per month. Having fixed overhead of 320. So the total overhead, you see, and one thing that that will help you is that this side will always be in value, this side will always be in units or labor hours. So basically that is that. In this question, you see clearly that the budgeted overhead, the fixed one for everybody, is 320. And the budgeted level of activity is 80,000 hours. So you have to read into it. Now, 80 divided by 320, that's like 4. All right. So that would be like 4 cedis per hour. Sometimes the level of activity can be in units. So read the question well. You pick one. All right. So if this is the case, we have done our overhead. The A part is answered. Now, it says that what is the amount of any over or under absorption? Now, let's find out. This is the overhead absorption rate. So you multiply the overhead absorption rate that you have by the actual hours that was worked. So that is that. So it will be the amount absorbed, into the unit of what we produce or the hours that we use. We used 78,000 hours. and each price is at 4 Ghana cedis. So 78 multiplied by 4 will be how much? Quickly. But the actual one they also did is the actual overheads they did, the fixed overhead they did is, so when you multiply the top one, what did you get? This one is 315,500. So what will be this one? 78,000 multiplied by 4?
312,000.
312,000. So anytime you get your overhead absorption rate, you have to multiply it with the level of activity. All right. Multiply it with the actual level of activity so that you know the amount absorbed. So they absorb this into the product. They absorb this into the product. But the actual is 315. So when you do that, you will see that they under absorb. Clearly, they under absorb. So if you look at it, you see that what they absorb into the product is 312. That is the cost they put into the product to be expecting from our customer, the entity's customer. That is what they put inside the pricing of the cost. But the actual amount they spent in producing the thing is 315. So which means that they will be running at a loss. The customer is paying lower than what the actual is. So the difference, I guess, is 3,500. So this one is an under absorption. And we say for under absorption, what do? It's either you add it to your cost or you subtract it to your profit. All right. It's either you add to cost or you subtract from profit. When you add to cost, you're actually subtracting from your profit. So because when you add it to the cost, you are increasing the cost. And if you deduct it from your sales, automatically your profit will come down. So it's either you say add to cost or deduct from profit. From the template that I gave you, an under absorption is deducted from the gross profit. If you saw it, under absorption is deducted from the gross profit. So that is that. All right. So that is the question. I think that is it. Now let's look at a bigger picture. A bigger picture. Let's look at the bigger picture. Now the bigger picture here is the illustration 19. Is the illustration 19. All right. So we look at it. It says XPLC produces one product, that is desk one. Each desk is budgeted to require 4 kg of wood at a price of 3 per kg. All right. Then we have 4 hours of labor at 2 cedis per hour. These are all direct labor and direct material. The variable cost of production is 5 cedis per unit. Fixed production overheads are budgeted at 20,000 per month. Average production is estimated to be 10,000 units per month. The selling price is fixed at 35, and there is also a variable selling cost of 1 cedi per unit. Fixed selling cost is 2,000 per month. During the first 2 months, XPSC expects the following levels of activity. So January, production level of activity is 11,000, February 9,500. Sales is 9,000 in January, and February it is 11,500. Prepare a cost card using absorption costing. And number 2, you are supposed to also set out budget profit statement for the month of January and February. So how do we do costing, cost in terms of absorption cost, absorption costing? We will do prime cost plus production overhead. The production overhead, we have to add fixed and the variable, because we say absorption costing is also called full costing. Absorption costing is also called full costing. So you will have to add all production costs to it and subtract all non-production costs. So with this one, we know direct labor, direct material per the question. If you are producing 1 unit of a desk, you will need 4 kg of material of wood multiplied by price per kg is 3. So you have 12. Then direct labor, you will need 4 hours and the price of each hour is 2. So that makes it 8. All right. Then we don't have direct expenses, but we have overheads. Don't forget, here we said that you add both fixed production overhead and variable production overhead. The question gave variable production overhead. So we have variable production overhead. Variable production overhead. The question said it is 5. All right. But for the fixed production overhead, that is where everything comes from. We are going to do the overhead absorption because the thing is fixed, but we want to only share the part that belongs to the cost of the production in terms of producing 1 unit. So we have to do our overhead absorption rate, find out the rate that we will use to absorb the situation. All right. So we know our overhead absorption rate formula, and we will use that to find the price per fixed overhead. So overhead absorption rate, we know it is given by budgeted overheads over what? Budgeted level of activity. And in this question, the budgeted level of activity were in units, not hours. So always check that. All right. So how are we going to do that? We are going to do that. So read the question where it says that the fixed overhead is 20,000. So it means our budgeted overhead. So it is budgeted fixed, all right? Budgeted fixed overhead, which is 20,000 cedis. And so the top should always be an amount. So you should never make a mistake of turning it around. And the average production estimate, so the estimated budgeted level of activity, the average, all right, the average, because here they gave you January, so the average one, the question said is 10,000 units per month. So you see that per one will be, if you divide, you will get 2 cedis per unit. So here will be 2 cedis per unit. And so when you add everything up, the cost is, here is makes it 20, is 27. 27. That is that. So the question said, prepare a cost card using marginal absorption. So this is the cost card. This is your cost card. All right. So basically, that is that. So that is it. And the question said they sell the thing. When they are selling the thing, there is a price at which they sell it. They sell it at 35. So it means that if selling price is, let's say, 35, it means the company will get a profit of around a difference, which is 8. That is that. But this is the cost. All right. Now, B says that we should do, what do we call it? A budget, set out a budget profit statement for month of January and February. So we are going to set it up. How do we do profit statement? So the template we had here, so we can actually use this template. So if you check, what is the sales? How much is the sales? We said that you will need the sales unit multiplied by selling price. So how much would that one be? So let's go and do it downstairs. So we will need sales. So let's say income statement or profit statement. We will need sales. And the sales is given by, we have the number of units. So let's say January, let's use this one for January and use this side for February. All right. So January, what is the sales quantity? The question said that they sell 9,000 units. And the 9,000 units, we knew that the price is 35. So multiply. Then when you finish, you come to this side. They produce how much they sold how much in February? 11,500 units multiplied by 35. So what is the amount? I need to fetch my calculator. All right. So the first one is
The fifth for February is 402,500.
402,500. Yeah, that's true. That's what I also had here. 402,500. All right. So, and this one is 9,000 multiplied by 35, and that gives me 315,000. That is that. Then we come to lessen our cost of sales, like we learned. So you less cost of sales. And that one we said we will need opening stock. We add purchases. So opening stock. But we were not given any opening stock in this one. So it means here we don't have. If the question gave us, we would. But I remind you that the closing stock of January will be the opening stock of February. Mind you. So add opening stock, add purchases. But here we said this is the production center, so we don't do purchases. We rather do what? Production cost. So you will need your direct materials, direct labor. All right. And the direct material, how much is it? We produced 11,000. 11,000 units is what we produce. And the price of each, what is material price? We did it here, is 12. So you put there 12. Then the labor to the same thing. All right. The labor, you are producing 11,000. And the labor hours for each, that one too is 8. All right. So take note of that. All right. 4,000, 4 hours per unit. All right. So you multiply it and the price is 8. You saw it up there. All right. So that is that. Then the variable cost to the sale is 5. All right. And you produce 11,000. So the variable overhead variable production overhead will also be 11,000 multiplied by 5. Good. Then the fixed production overhead. The fixed production overhead. So all these things we are doing is add production cost. The fixed production overhead. That one too, you produce 11,000 according to the question for February. And the price, what price will it be? If you remember that in the format, I told you that the closing stock will be valued by or using the absorption. So whatever you did, the absorption amount, we did it somewhere here, is the total with the absorption is 27. So that's how much we are going to price our closing stock. But the variable overheads are here. Then the fixed overheads too, we are told it is 2. All right. So here will be 2. Okay. So that is that. And we will say less closing stock. And how did we say we find closing stock? It is the opening stock plus production minus sales units. Don't forget, we showed all those things there. All right, don't forget. Now, if you do this side, let's get the figures before we come to the closing stock. So here, if I multiply, I have 132. In fact, any number multiplied by 11, you just add the numbers together, 1 plus 2. Then you put the answer in the middle. So the 1 and the 2, when you put it together, any number multiplied by 11, that's how we do it. All right. So that is that. So this one too is 0 that is in front. So 8 plus 0 will be 8. And you put it in the middle, you have 8, 8, 0, 0, 0. So this one too, likewise, it will be 55. I learned this thing when I was in JHS, when we were doing mentor. So here too will be 22. Any number multiplied by 11, just add the numbers and put it in between the number. All right, so that is that. So here, when we put all these things together, 132 plus 88 plus 55 plus 22, that gives me 297. 297. Then I will less my closing stock. He said that the closing stock, how do we find closing stock? Closing stock, you will need the opening stock, which is 0 in our case, plus the production units. How many production was done? 11,000. Minus the sales unit. How many is the sales unit? So obviously, if you produce 11 and you sold 9,000 without having any opening stock, the balance that you have for your closing stock will be 2,000. And we price the 2,000 using the absorbed pricing. So what we absorb in, we will use the absorption costing to do the closing stock. And per the absorption costing, this is the value of a closing stock. All right. And so we are going to price this one at 27. So that is it. That's the trick there. So here we have 2 multiplied by 27. That gives me 54,000. So that is that. I less my closing stock. So the 54 minus 297, that is 243. So I have here 243. All right. So if I check my gross profit, my gross with 315, my gross profit will be 72,000. Now, this is the unadjusted gross profit. Gross profit, like we had, is unadjusted. So we are going to adjust it with over and under, if any. So unadjusted. So do we have over or we have under? Now, how do we do that? We have done the overhead absorption rate. We have 2 for the fixed. We are going to multiply these 2 by the level of activity that actually happened. The level of activity here was the production. If you check what we produced in January, it was 11,000. And so the absorbed is 22,000. But what is the actual? The actual, we were told that the actual is 20,000. The actual fixed is 20,000. You always see it's here, 20,000. So in this case, if the absorbed is 22,000 and the actual is 20,000, then is it an under absorption or over absorption? Yes. If the absorbed is 22 and the actual is 20, is it over or under? Any idea?
Over.
Over. And if it is over, what did we say we will do to your profit?
You add it.
You add it. Very good. So go to the over absorption. Over absorption. So you realize that the absorbed was 22. The actual was 20,000. So we will just add the difference of 2,000. So our adjusted gross profit will be 74,000. So the gross profit adjusted. So that is what we have. The last thing we need to do is to less all our non-production overheads, all the non-production overheads that we have in the question. So if you look at the question, did it give us any non-production overhead? There are other variable selling costs. There are also variable selling costs. Selling is not production, so that is one. And a fixed selling cost is selling. It has nothing to do with production. So these are the things we will less. So you will less selling variable or variable selling overheads. And the variable selling overheads, what we did is that we sold 9,000 units, and the variable selling is priced at 1 cedi. And so here we just have minus 9,000. And the fixed one, fixed selling. So that one too, we had the fixed selling is 2,000. You see, it is not variable, so you cannot multiply it by the sales quantity. It is fixed. So back the figure, fine, as it is. And as we have here, it is 2,000 in the question per month. So you just do 2,000 per month. So now when you put everything together, you have 74 minus 9 minus 2. And so our final answer is 63. And that 63 becomes our net profit. All right. So basically, that is how you do the whole absorption thing. If we continue to do the one for the, what do we call it? The February, the danger is that, now we will have opening stock because closing stock of last month becomes opening stock of the new month. So that is that. So here, opening stock will be there. So our opening stock will be this one, the closing stock of this. That is how it will be. So opening stock here will be 54. Then we come to the direct material. How many was produced in February? 9,500. This is it. 9,500 multiplied by the price before, that was 12. So the same thing will be repeated. So 12 direct labor, 9,500 by 8. Then we have the variable overhead, production overhead, variable production overhead, 9,500 multiplied by 5. Then we also know our absorption for the fixed one, fixed production, don't forget that, which is 9,500 multiplied by 2. All right, so that is what we have. So now, let's do it quickly. 9,500 multiplied by 12. That is 114. Yeah. I'm doing from the bottom. 9,200, 9,500 multiplied by 2. Here gives 19,000. And 9,500 multiplied by 5 gives me 47,500. 47,500. And 9,500 by 8 give me 76,000. So here too, let's total everything. So 54 plus 114 plus 76 plus 47,500 plus 19, a total of 310,500. Then we are left with the closing stock. We need to less closing stock. How do we get our closing stock, the number of units for our closing stock, which we are going to price now? So we are going to price the closing stock now. So you realize that you had opening stock. In this case, this is your opening stock. You had like is it 2,000? Yes. So you see that your closing stock, we have closing stock. We had opening stock to be 2,000. The formula is opening stock. So opening stock was 2,000. Add the production, which is 9,500, minus your sales. Sales, how much did they sell? 11,500. So it means that technically there will not be any closing stock because everything has been sold. Because this together is 0. So it means everything has been sold. So if everything has been sold, then the 310,500 becomes our cost of sales. So here will be 310,500, which we are taking out of our 402,500. And that gives 92,000. So that is our gross profit that we have. And it is unadjusted. So we need to look at the absorption again, over and under absorption. So here what happened? We know the absorption thing, the price is what do you call it? Is 2, right? So the pricing was 2. But here, what is the actual? So over here, when we did it, it was the absorb. We had 2 and we multiplied by the actual the budgeted overhead. So this is what we did with the level of production. Now here the level of production is 9,500. So here it will be 2 multiplied by 9,500. So it will be 2 multiplied by 9,500. And 9,500 multiplied by 2 gives 19,000. But the actual was still 20,000. So here it means we have under-absorbed. And when we under-absorb, we will have to treat it as a loss. And so therefore, under-absorption, we will deduct. So you have to show working of the under-absorption. So like we did the 19,000 versus 20,000, under-absorption of 1,000. And so the gross profit adjusted is 91,000. All right. And in the same vein, you have to less your variable non-production. So the variable non-production, variable selling. How many did they sell? 11,500. And here you multiply it by 1, right? So 11,500 multiplied by 1 because they said it's 1. So here will be minus 11,500. But the fixed is fixed. So the fixed one is still 2,000. And so when you less everything together, so minus 91 minus 13.5, that is the figure there is 77,500. So this is how we do absorption costing. All right, this is how we do absorption costing. Now you have to learn some advantages and disadvantages of absorption costing. Let's see if you had our figures right with the solutions. All right, so that is fine. So now you have to learn some advantages and disadvantages of absorption costing. Of course, I've said time and time again that the absorption costing is in accordance with IAS 2. All right, it is recommended by IAS 2. All right, so that is that. And we said that it uses the full cost. So many companies fix selling prices of a product by calculating the full cost. So that is, then they add their own margin, their own profit margin to get the selling price. So that is it. So it is something that is useful for pricing decision. It is useful for small companies, all right, producing single product or few products. So that one is that. Okay, yes. And all the traditional methods are less time consuming. All right, it is less time consuming. So it is less time consuming, and it is very simple in comparative to the ABC. We will be doing ABC, and you will see. All right, but using a single basis to allocate overhead costs is unlikely to give accurate. So this one is just like the blanket, like we studied in the previous lecture. It's just like the blanket, and so it doesn't really give accuracy. All right, so that is that. Okay, so it can only work for single product and simple manufacturing, but big companies produce massive units, and so it will be very, very difficult for you to use it in the big production, where there are complexities in how production is done. This one is machine intensive, labor intensive. It doesn't take into consideration the cost that people are making to get the product produced. It doesn't. And so very soon we will be looking at the ABC. All right. And it is very difficult to justify. Why? Because the overheads are usually high than the direct production cost. And addressing the overhead cost by means of time spent may not really portray the reality. There are other factors to it, and we will learn those ones when we are doing the ABC. All right. So basically, that is that. Now, let's take a quick look at how the marginal absorption works. The marginal absorption, how does it work? All right, so let's look at how we do the reporting now under the marginal costing reporting. Now, under marginal costing reporting, this is how we get profit. So we will get our sales or revenue. All right, so you get your sale or revenue. Then you will take away variable costs. Variable costs. Bear in mind, when I was teaching the element of cost, we knew that direct material, all prime costs are variable because they move with the level of production. If you are producing 1, you need 1 kg of a material. If you are producing 2, probably you need 2 kg of the material. So they vary with the level of production. So all the prime cost is deemed variable. So that is that. You less variable cost. All right. Then when you less variable cost, you get your contribution. Contribution. All right. So here our focus is on only variable cost of production. Then we will less the fixed cost of production. So the difference between the marginal or the variable costing is the fact that in determination of gross profit, in this case, what we call contribution, we don't add the fixed overhead, the fixed production overhead, like we did in the marginal, the absorption. So here, only variables are there, only variables. You don't add the fixed, because production overheads are grouped into fixed production overheads and variable production overhead. So when you are doing the marginal or the variable costing system, we don't add the fixed cost. All fixed costs are deducted after you get your contribution so that you get your net profit. So this is how we do it. So that is that. So the way we did the marginal cost, the absorption costing, where when we went down, we did fixed non-production overhead. So we said minus fixed non-production overhead and variable non-production overhead. Here, we will bring all the variables at the top and subtract from the sales. So anything variable, so far as it is variable, you will have to bring it here and do the subtraction so far as it is variable. So that is that. So you have to make sure that you brought all the variables production cost and you will subtract. All right, so basically that is that. So all variable costs, all right, including the so we call it here, it is the variable cost, both the production one and the non-production one. So the difference between this one and the absorption is just the split between the variables. Now, I think I still have the absorption. So when you go to the absorption, this thing we did, we had here, all right, the production overhead. Here, it included the fixed and the variable. And we came here, we said variable non-production overhead. So in the absorption, this one will be added to the variable that is here. And the fixed that is within this one will also come down. So that is the switch that happens there. So that is the only difference. And number two, the closing stock will be measured at variable cost. All right. So that is that, not the absorbed one, the one you did using absorption. So basically, that's the general idea. All right. So how is the reporting like? If you are reporting under marginal costing, how is it like? So you will get your sales, the sales, like the way you did in the absorption. You will less cost of sales. So that is where everything changes. That is where everything changes. So the cost of sales, how do we do it? You will start with your opening stock, like the way we did opening stock. So you have your opening stock. And opening stock is just the opening stock unit multiplied by the cost per unit. All right. And here we use variables. Less production. So opening stock, add production cost. So here we say add variable production cost, not full. In the absorption, we call it full production. But here we say add variable production cost. And we said all the prime costs are variable. So direct material is variable. Direct labor is variable. If there is any direct expense, which you will hardly get in any question anyway, is also variable. That is that. All right. So you will add variable overheads. So variable overheads you add. And I put this one in red ink in the other one. So let me continue with it. So variable overhead. So variable overhead, whether production or non-production. So you put them together. All right. So the production and the non-production, put them together. So that is that. Then you will less closing stock. Bear in mind, closing stock. The closing stock, remember how we find closing stock? It is the opening stock plus production or produced unit minus sales unit, the same thing. So when you get that, it will be your closing stock multiplied by the variable cost per unit. All right, so you subtract your closing stock, then you will get your cost of sales. Once you get your cost of sales, you deduct and you get what we call contribution. This time around, not the term gross profit, but we call it contribution. So you get your contribution. Then you less all fixed cost, whether production or non-production. So less fixed costs, both the production fixed cost and the non-production fixed cost. So when you put them together, you will less it. And that is how you get your profits. So easy peasy, That is that. So what we're going to do is that we're going to take the same example that we did, and this time around we are going to do it in terms of marginal costing. All right, in terms of marginal costing. All right, so let's go back to our manual. So illustration 10 is the same example, but in this time we are going to use marginal concept. All right, so that is that, the marginal concept. So take a look at the format very well, and quickly we will do marginal cost with the same thing. All right. Okay, so now let's set it up. The question, the same thing, the same question we had, and this time around we are preparing the cost card using marginal, and the profit also using marginal, the profit statement. So the cost card, we know for cost card, you will need the prime cost plus the overhead. But since we are doing marginal, let's see. Marginal. The only thing that we will do is that we will need our direct material. And the direct material per unit, we saw in here that we will need 4 kg of the material, and one is 3 cedis per kg, and so we will have 12, the same thing. Direct labor, I think we had 8, so those things will be the same. All right, so 4 by 2, 4 hours by 2 cedis per hour, we had 8. So that is that. Now, the issue is about marginal, and marginal is also called variable. So we are only interested in the variable ones. Only interested in the variable ones. So that is all we know. Bear in mind, we have variable overhead according to the question. Variable overhead. And the variable overhead is 5. That is what we had. That's what we have. So this is our, if you check this, if you add this together, how much are you going to get? How much are you going to get? That's 25, right? That's 25. But we also have another overhead that is there, if you remember. So that one is the, where was it? This is it, the variable selling. So we told you that the variable, we add variable production and non-production. So this one was for production. And there is a non-production, variable non-production. So we add all variables, whether production or non-production. So take note of that. But you see, the reason is that you have to split it well, because this one, as you see, the one that you have here is variable cost of production, variable production cost. But there's another variable selling, that one was non-production. So you have to include that one in, all right? So when you have that, that one too is another variable. So that is that. You have to take note of that one. So you see all variables are catered for in that, all right? So that is that. So it means that here the total variable cost will be what? Total variable cost per unit. Variable cost per unit will be 26. All right, so that is that. And this is what we will use to value our closing inventory. So take note of that. That is what we use to value our closing inventory. All right. I hope it's clear. Do you understand?
Yes.
All right. So that is how you value it. Now, let's go into the question and do the reporting. So this one, our value here is 26. Now, so what we have here per this question, we are going to set up our January and February just as we did for the absorption. So here we have January and we will do February. So we have sales. The sales in January, they did 9,000 units. Then multiply by, what was the price again? The same 35. I've forgotten the value we had. So let me.
315,000.
Yeah, 315,000. That's good. 315,000. Was it 315,000 solid or 500 was added? Just
The
300.
500 is for the other one. 402.
Oh, okay. So February was 402,000. Okay. So let's do February too alongside. So February, how many units? 11,500 by 35. That one we said 402,000, 500.
Yes.
402,500. All right. Okay, then let's go to the less cost of sales. So our cost of sales, we have opening stock. For January, there is no opening stock. So then we add production, variable production cost. Variable production. Variable production. So if you do variable production, we have direct material, and the production here is 11,000. So the same thing. You remember the figures. It's the same 12. Do you remember the figures? I said anytime you are doing this one, you put the number in the middle. 132, right? Direct labor. I need to charge the laptop. 11,000 multiplied by, was it 8? And it was 88. We don't have a problem with those ones. Let me charge this machine now. So that is that. But the rest of the things that are left here is about the variables. So now we know that there is variable production. Variable production, which will be 11,000 multiplied by the 5. That gives 55. But we also know that there is another variable selling. So all variables, variable selling. And here, be careful because the selling is 9,000. They are selling 9. And the variable selling, the price was what? 1. So here is 1. So that is 9,000. All right. So you have to be very careful about those things. So when we add everything, we need to add everything and less our closing stock. So here we have 132 plus 88 plus 55 plus 9. And that gives 284. 284. So that is what it gives. Now let's less our closing stock. Closing stock, our opening is 0. Production, 11,000. Minus sales, 9,000. So we know our closing stock is 2,000. But the price at which we are going to price it is how much? Do you remember?
25.
Was it 25 or 26?
No, 26.
It's 26. Yeah, 26. So here is 26. So 2,000 by 26. So 2 by 26. That gives 52. That gives 52. But one thing you have to be careful about is the production side. And so we should be careful and actually split the production with, it is closing stock, all right, that we are valuing. So we will have to go back and use the 25 because it is stock that we are valuing. All right, closing stock. And I will explain that to you. But we will still have to take out the one for the one. It's dangerous. It's very, very tricky. So watch this. Like I said, I think I did the 25 there. Oh, let's go up. So look at it very carefully. That's the trick there. You see, we are valuing stock. Stock. All right. The other one is selling. And so we will have to use the 25 for the stock, but we will still have to deduct the one. So you have to be very, very careful about it because of our, what do we call it? Our opening stock issue. Because we will have to be doing opening stock. So we need to be very, very circumspect about that area. We can use the 26, okay? You can actually use the 26. You are not wrong because at the end of the day, it's 26. So if I use 26, for example, for my valuation of the what we call it, the 2000 stock, because I will still have to take care of the variable cost there. We will still have to take care of that. But for the purposes of valuing our closing stock, I think we need to use the 25 because that one was for the stock. That one was for the stock. So if you use that one for your stock, you will still have to deduct this thing anyway before you get your contribution. So either way is fine, but you just have to be careful that when you are pricing the thing, especially your opening, you have to be very, very careful about the opening stock that you will be doing. That one is dangerous. So you here for now. So there are two ways you can go about this. So you can say 26 by 2. This is 52, right? That is it.
Yes.
But you have to be very, very careful because of the purposes of what do we call it? Closing stock. You have to be very, very careful. It's dicey, so I'm even circumspect in doing that. I'm careful in using that approach because what we should actually do is that for the purposes of our closing stock, this is how it will be. It should be like this 25 because that one is for production. You saw it here. For stock, variable production, this is selling, but we will still have to deduct selling because I said for every marginal, this is what you do. So you less these ones. So you do this, you will less all your variable costs. So you see the variable, I said both production and not non-production. So we will have to less both production and non-production. So what we have done, okay, I actually did it, right? So we did both production and non-production. Okay, that's fine. So that is that. We have done that accurately. But one thing we should understand is that when it comes to valuing the closing stock, we have to use the variable cost of production. So that is that. So this is it. The variable production cost. All right. So here actually should be 25, like you said earlier. All right. I don't know whether you said that by mistake or you said it by understanding. So 25,
It was a mistake.
it was a mistake. So 25 by that will give us 50,000. That is what we will have. We will have 50,000. So we don't include the selling into the closing stock. It should be variable. So that is why I split. I actually split this thing into two. All right. So that is that. So the danger is that, oh, I think I made a mistake for you. I actually said, if I remember, I think I said you use this one to value your closing stock. Probably the reason why I did the arrow, but this is it. You use this one to value your closing stock. So take note of that. That is very, very important in terms of the closing stock valuation. We use the variable production overhead. Variable production overhead. But in terms of getting your contribution, you have to subtract all forms of variable cost, all forms of variable cost. All right, so take note of that. Okay, so that is that. So here will be 50. You've done that. And so cost of sales will be let's find the cost of sales. So 284 minus that's like 234, right?
Yes.
Yeah. So what will be the contribution? So 234,
81.
that's 81. All right, good. All right. So now that we have 81, we need to now list all forms of fixed cost. All forms of fixed cost. So this is contribution. Good news is that here there is no over or under absorption because we never did absorption. So you list all fixed cost. So the fixed cost, how many fixed costs do we have? We have selling fixed cost and production fixed cost. So the production fixed cost was 20,000. So here the production one, 20,000. Then the variable one is 2,000. All right. So basically that is that. And so when you take everything out, 20, that is 61. So that makes it 59. And that is your profit. So the danger in doing the marginal costing is that in as much as we will bring the variables here, our closing stock must be variable production cost, not just variable cost, but what? Variable production cost per unit. So that is that VPC, variable production cost. That is what it's supposed to be. And I think I made mention of that here when I was actually drafting the thing. All right, so this is it. Supposed to be variable. So how do it should be variable production cost per unit. So it's like this. Variable production cost, not just variable cost, but variable production cost. So let me specify it for you. So closing stock multiplied by variable production cost per unit. So let me write it like this so that you get it clear. Not the total variable cost like we have it here, but variable production cost. All right, so take note of that. Let me stress on it again. Variable production cost. That is what we used to value closing stock. Variable production cost. All right, so take note of that. All right. So basically that is that. So the same thing you did, now you've done it. So when you come to your February, the closing stock that you had, which is 50,000, will be there. Will be your opening stock. Your opening stock will be the 50,000. All right, that's how you have it. And the other things, the direct material, this time round, the production is 9,500, and we did that in the absorption. So by 12, DL 9,500 by 12, by 8, right? DL was 8, eh?
Yes.
Then there was a variable production, and so that one to 9,500, and it was 5. All right, so there you go. And I think in this one there was no closing stock, if I remember correctly. And I remember here's 114. Then you have this one was it 76? Let's just punch it again. 9,500. Yeah, 76.
70.
Come again.
70. I was saying that yes, it's 76.
Yeah. And this one, do you remember this one? So 9,500 multiplied by 5. That is 47,500. And there was no closing stock. So this is 47,500 plus 76,000 plus 114,000 plus 50. And what I have here is 287,500. So what will be my contribution? So minus 402,500. That is 115,000. So we less all our fixed costs. So the fixed cost is fixed cost. Fixed cost is 20,000, right? And 2,000 every month. So the fixed production one, then the fixed variable one. Variable. All right, that one was 2,000. So let's take away 22,000. All right, so that is that. I think the selling, is it the same? This one is the variable was the fixed is here. The variable here is 9,000. Did you do the variable here? You've not done the variable here, right?
Yes.
The variable non-production, like the way we did for this one, we've not done it. So let's bring it in. Yeah, let's bring it in. So let's say, because the variable here is 1 cedi per unit selling variable, but this time around they sold this quantity. So the machine. Okay, here you go. So let me delete this one. All right, so this one was 47,500, right? Then the variable non-production. So the variable selling. They sold 11,500 multiplied by 1 Ghana cedi. So we need to add 11,500 to this one before we get our contribution. There was no closing stock. So the figure there, I need to repunch 114 plus 50 plus 76 plus 7.5 plus 11.5. I'm having 299.
Yes, me too.
Yeah, 299. So 299 out of 402.5. That's 103,500.
500.
So now we take away our 20,000, the fixed production, and the 2,000. So minus 22. That is like 81,500. So that is that. 81,500. So this becomes the profit. So that is how you do marginal and absorption. The whole issue of contention is around this side. You need to be careful. And the closing stock, all right? So you need to be careful what we use to vary the closing stock. The value of the closing stock is the variable cost or variable production cost. Take note of that. The variable cost of production or variable production cost. So when you are determining the value you use to do the closing stock, be careful about here. All right. You don't bring the selling because that thing is a stock issue. All right. Not selling issue. So you have to be careful about this one, this side, and the fact that you need to also bring this side into the contribution determination over there. All right, so that is that. Let me see. All right, I think we had them. All right. So now the last thing is to reconcile the two. The one that you did in marginal, then the one that you did in absorption. You have to reconcile the two. All right. So if you saw what we did in marginal and absorption, so this is the reconciliation. So what you did in marginal, profit under marginal, then you check your over and under absorption the increase in the stock because of what happened. All right. So, and you will see that when you adjust it with that, you will see that you get equal to your the profit you get under absorption. So look at the profit we get in what do we call it, in January. If you check the absorption costing we did in January, we had 63,000. So yeah, so the absorption costing we did, the profit was 63,000, and it is because of closing stock, because of the value, the absorption thing under closing stock. Yeah, that is the reason for that. So if you look at what we had here, 63,000, and the one that we had in the marginal, which is 59,000, you see that the difference is 4,000. Now, if you pick it from your closing stock, your opening stock, you had opening stock, there was nothing for opening stock in January, so that is dash. But there was the same thing. There was a close, what do we call it? The opening stock, the closing stock in January became the opening stock in February. So the closing stock, you saw that if you value your closing stock, where is the closing stock? Here, the closing stock. If you take the 2,000 that we did and you multiply it by the overhead absorption rate that we did, the overhead absorption rate for that one was 2. So if you do and you multiply, you get the 4,000, and you see that that is the reconciliation. So what we are saying is that, for example, if I pick I want to reconcile the two, I start with my marginal. All right. So in the marginal, I had 59,000. You remember, I had 59,000. That is what we had. Then if I pick the closing stock in January, which is 2,000, and I multiply it by the overhead absorption rate in the absorption one, I will get is 2, so I'll get 4,000. And if I add it, it will be equal to the profitability in the absorption one. So that is what we are saying. And by that, you reconcile. You see that here you also have 63. And this is what you have. If you go to February, the same thing. The February, this one, we had 77,500. But in the other, in marginal, how much do we have? In marginal, we have 81,500. So that is that. 81,500. All right. But the same stock we had for closing is what you have for opening. So if I adjust it with that, I think I should be getting is 81,500. So if I adjust it with the difference of 4,000, you will see that I should end up with the same thing. So basically, that is that. Bear in mind, this one is a closing stock. You know, closing stock, we deduct closing stock. So all that we did is that we added it back. Opening stock, we add. So all that we did was to subtract it back. So that is that. And that is how you do the adjustment. So lastly, what you need to do is to understand that in marginal costing, closing stock are valued at marginal production cost. And that is the mistake when we were doing it, we nearly had. It is valued at marginal production cost or variable cost of production. All right. Fixed costs are period cost, and cost of sales does not include the share, include a share of fixed overhead. So take note of that. All right. But in absorption costing, it does include it. And the closing stock are valued at full production cost. All right. So what you need to take home is that if closing stock is greater than the opening stock, then the absorption costing profit will be greater than the marginal, like you see over here. Okay, so you reconcile like that, like the way we did it. All right, so take a close picture of the additional loops, and like I said, download the past question and work at it. All right, just download the past questions. and work at it. All right. So the book too is also available. You can do. So that is the end of marginal and absorption costing. All right. So we've done the traditional costing. The next time we meet, we are going to go into the modern one, the ABC. We will be looking at throughput. We'll be looking at a life cycle, product life cycle. All right. So that is it. Thank you so much, and have a great evening.